We think that the U.S., which had a terrible fourth quarter, growing at a -6%, is going to have another very bad first quarter. All the data is looking just terrible. Probably another -5%, and then one more negative quarter. And then the U.S. bottoms out in the second half of 2009. Not strong growth, but at least the terrible negativity dissipates, and then 2010 starts looking better again. The problem with the stimulus package that was designed, it's a one-size-fits-all stimulus that has some impact on incomes, but a very small fraction of it is really targeted on the critical sectors. About $8 billion out of $770 billion of spending, only $8 billion is focused on homes and cars, and the rescue for restaurants and retail just isn't there at all. We're going to have to rely on growing incomes that will occur later this year and in 2010 before Americans will be buying their restaurant meals and going out shopping again. I think that the U.S. federal government will be running deficits for a very long time, and his goal of closing that deficit by half, it relies a lot on a kind of gimmick in the sense that he's doing the accounting to allow for the war spending in Iraq and Afghanistan. That was not part of the Bush design of their budget. So if you put that into the current deficit, a lot of that will go away as we draw down our commitment to Iraq. So you get kind of some significant relief there. But even with that, to half that deficit in its first term, that would be an extraordinary accomplishment. If we move toward a protectionist sentiment in the United States, that's going to be amplified with protectionism everywhere. It's the very last thing that the globe needs now. Well, Australia ships a lot to the United States indirectly through China. The story of the globe over the last decade has been codependence between China and the United States. China has provided us a product with extremely low prices and also the financing, so we could buy that without having to pay for it, magical financing. That has driven not just China, but the whole global demand for all the raw materials that go into that activities, and Australia is part of that story. South America is part of that story. But really, it's not just them, it's the whole globe has been very dependent on that codependence between China and the United States. That's a story that's behind us now. Not because of anything China did, but because of the fact that U.S. consumers have suddenly come to grips with the reality that they spend income that they're never going to have, and they're in the mood of repairing their balance sheets. And as long as they're doing that, that means a lot less borrowing from China, and it means a lot less buying from China, which means that the whole globe has to find a new way of creating economic growth, a new locomotive that will pull us forward. Over the last 6 months, the dollar has appreciated for technical reasons having to do with maintaining our global portfolios, but most importantly because global investors are completely fearful of the future. And the only place they want to put their money is in the bank called Uncle Sam. They're buying treasury bills, treasury bonds, driving those yields down to virtually zero. Zero for the 3-month treasury, the 10-year treasury paying only 2.5%. That's totally giving up on any hope about the future. As the global investors come to feel more optimistic about economic growth, there'll be a removement of that investment out of treasury bills. You'll see the dollar decline. You'll see the Australian dollar appreciate relative to the euro. In fact, or relative to the dollar. In fact, most currencies will appreciate relative to the dollar as the U.S. begins the very difficult task that lies ahead, which is to export more.